For this tutorial, we want to go through a sample form 1120, which is a U.S. corporate tax return, and it's going to be for the 2023 tax year. Now, in this sample, we are going to cover a scenario where a U.S. corporation owns U.S. rental real estate property, and that company is owned by a non-U.S. corporation. So we've got the 1120 here and all of the required forms and schedules. We've also got the sample financial statements here for the U.S. company. We've got the profit and loss, the balance sheet for book purposes, and then a book-to-tax reconciliation and a Form 8810 worksheet. So because this is a rental real estate type of business, we are going to have some passive activity loss limitations that need to come into play, and that's done on the IRS Form 8810. Which is part of the return. And then lastly, you've got just two slides here covering the fact pattern, which we're going to go over, and then a structured chart here on the second slide to try to better illustrate how this thing was set up. So if we start with the first slide here, then we'll get into the structured chart, and then the financials, and then the tax return itself. So what's all included here? We've got the base Form 1120, so that's pages 1 through 6. We're going to need the Form 4562 for the depreciation expense for the year. And then because this is going to be a company with non-U.S. ownership, we are including a Form 5472. And then it is a rental real estate activity, which is per se passive activity, right? There are rules to override that and make it non-passive. But in our example, we're going to leave it as a passive activity, and so we're going to need the Form 8810 to calculate the amount of allowed and unallowed deductions. We've also got some bonus depreciation for the year. So in 2023, bonus depreciation has dropped to 80% of that depreciable basis. In 2022 and a few years prior, it was a full 100%, but now bonus depreciation is starting to kind of phase out or phase downward. We're going to make the de minimis safe harbor election for property expenditures, and then we're going to attach a Section 351 statement to show the capitalization of the corporation. All right, so now the fact pattern here. We've got Hans Smith. He's a German citizen, so not a U.S. person, and he lives full-time in Dubai, right? So he was living in Germany, moved to Dubai, and he wants to purchase a real estate investment in the U.S. And the plan is to buy this property and rent it to a tenant. He's advised that owning U.S. real estate individually, not a good thing for non-U.S. persons, so he's going to do it through a U.S. corporate entity. Now, he already has a existing Cayman Islands Corp, so he owns 100% of the stock in a Cayman Islands company, and he uses that to make investments. And so he's going to open this U.S. Corp via that Cayman Corporation. So the Cayman Corporation forms a Wyoming Corp. That Wyoming Corp issues 1,000 shares at $1 par value, common stock, and the Cayman Corporation contributes $1.2 million, so $1,201,000 in cash to the Wyoming Corp. And so the breakout of that amount is $1,000 is the common stock, and then the additional amount of $1.2 million is APIC, so additional paid-in capital. So if we quickly jump to the structure chart so we can get a visual as how this is looking. So we have Hans owns 100% of that Cayman Islands company to corporation, and then this entity in turn owns 100% of the Wyoming Corporation, and then the Wyoming Corporation is the entity that is buying the U.S. rental property, and it's also going to be opening a U.S. bank account. All right, so the Wyoming Corporation, after it's funded, purchases a home in Cheyenne, Wyoming. It pays $1.195 million in cash, and Hans finds a rental property management to take care of all the day-to-day. And so the property is ultimately rented to a tenant for $7,000 a month, and that lease starts on July 1st, 2023. Now, Hans is not going to be involved in any of the kind of the active management of the rental property, right? He wants to be completely hands-off. And the corporation isn't going to have any employees, right? It's just going to be outsourcing the management to this third-party company. And so our position under this fact pattern is we're not going to meet any kind of material participation standards. We only have one property, so it's not going to give rise to a real property trade or business. And highlighting these because this is important for these passive activity rules, right? If your facts and circumstances are different, if you have more properties, if you're more involved, then maybe you can override those passive activity rules. But in this case, for purposes of completing the 8810, in this example, we're going to take the position that this is going to be a passive activity for this company, all right? And then one little additional element for the 5472, the Cayman Corporation has its own outsourced accounting provider, and so the provider is going to take care of the books for the Wyoming Corporation, and so the Cayman company bills the Wyoming Corporation $1,000 for shared accounting services. All right, and so that is something that's going to be disclosed on the 5472. Now, as far as what filings need to be required here, right, this is a U.S. corporation, so we're going to be doing an 1120. Now, as far as Hans goes, he doesn't have to be filing any personal taxes. So he's not filing a 1040-NR because this entity in the middle acts as effectively a blocker corp. So the Cayman company, as a foreign corporation, could file an 1120-F, right, on a protective basis. But for the most part, it doesn't really have to do much because all of the reporting is going to be done at this level here. If any dividends were distributed to the Cayman company, Wyoming Corp would have to withhold tax, right? File 1042Ss. So again, most of the work from the U.S. perspective is done at this level if it's set up in this manner. All right, so let's have a quick look at the financial statements. So these are the financial statements for book purposes. And so what you will notice, two big things. So they're not recording any depreciation expense. So when we look at the fixed assets section and the breakout of the property and the land, we don't have any accumulated depreciation here. We don't have any depreciation per books. But for tax purposes, we're going to be claiming it, right? And this kind of setup is not uncommon. A lot of companies want to see what their cash flow looks like rather than record depreciation expense. But you could record it if you want, but in this case they're not recording depreciation. So we've got the revenue over here, $42,000, all the expenses that are attributed to operating the rental. Net income per books is $24,662. And so on the balance sheet side, we've got the balance of the cash accounts. We've got the fixed assets section here, right? The house, the land improvements, the appliances, carpets. So all of these items were broken out from the purchase price because we can claim bonus depreciation on these items, right? So the house is depreciated straight line over 27 and a half years. But if you've got these other types of items, furniture, fixtures, other improvements that are sub 20-year property, you can make them eligible for bonus, right? And so that's why we have them separated. And then, of course, land is not depreciable, all right? So land has to stick out there on its own. Security deposit, equity section for the capital stock and the APIC. So pretty straightforward here, all right? Then if we look at the book to tax reconciliation, so I'll cover this very briefly, and then we'll start looking at the return and kind of go back and forth. So we've got the income or expense per books, right? So these are those items here. Again, we don't have any depreciation expense being recorded. And then the taxable income computation for the federal tax purposes in this column, again, we have the same amount of rental income. All the expenses that are eligible for being deducted, those are fine. And then we've added the bonus depreciation, the straight line depreciation that can be recorded once we get all of those inputted. Now, the reason why I separated all these out by recovery year and whether it's bonus or not is because of the 8810 worksheet. So we'll see here that our net income for income tax purposes is minus $95,000. So we have a net loss for federal tax purposes, but because it's a passive activity, we can't deduct the full amount of net loss. We have to reduce our expenses pro rata in order to account for the unallowed deductions. And so that's what this worksheet is going to be accomplishing over here. So we'll come back to this in a little bit as we start to look at the Form 1120 itself. All right, so let's have a look at the forms and start going through all of these. So the basic stuff at the top here, right, we've got the name of the corporation, mailing address. We do mark in item E that it's an initial return. We have the company's EIN, the date it was incorporated, and then the total assets per Schedule L on the balance sheet. Now, because it's not a full 2023 calendar year, we've inputted the date it was set up through the end of the year, 12/31. All right. Now, if we start with the Schedule K instructions, or section rather. So a lot of yes or no questions in here. This is kind of good to start with in order to determine what additional schedules or attachments you might need. So at the top, we're going to be operating under the accrual basis, business activity code for rental real estate ventures, and so we are a real estate rental business. In item 4 here, it's asking us, did any foreign or domestic corporation own 20% or more of the stock? In our case, yes, right? We have a foreign corporation that owns 100%, so we are attaching a Schedule G. And then for B, it's asking us, did any individual own directly or indirectly the stock? And the answer is also yes, right? Because if we look at our structure chart here, the direct owner is the Cayman company, owns 100%, but indirectly here, Hans owns 100% of this company by virtue of him owning 100% of the holding company in Cayman, right? So Schedule G is attached. If we go to that really quickly, and then I'll jump back. So we have Schedule G, entities owning the corporate stock. We have the Cayman entity, not real holding company limited. It does not have an EIN, so we use foreign U.S. as a placeholder. It is a corporation. Country of organization is the Cayman Islands, and it owns 100% of the stock. In Part 2, when we disclose the individuals, we have Hans. He also does not have an ITIN or an SSN, so foreign U.S. again is a placeholder. He's a German citizen, and he owns 100% indirectly via his ownership of the Cayman entity. Okay, so if we go back to Schedule K and keep on going through here, the corporation doesn't own any subsidiaries or other interests in entities, so those are blank. In item 7, it's asking us, did any foreign person own directly or indirectly 25% or more of the stock? And the answer is yes, right? So we've got 100% ownership by a Cayman Islands company, and so we're going to be attaching 15472. Item 10, we do have one shareholder, so that's being entered there. Schedule K, page 5. So again, a number of yes or no questions. So 13, are the corporation's total receipts and assets under 250? And the answer is no, right? Our total receipts are under 250, but our assets are in excess of $1 million. So we have to complete Schedule L, M1, and M2. We did have to prepare and file 1099, so that was taken care of. Item 18, so Section 351 transfers. These are capitalizations of corporations, so the transfer of property in exchange for stock, which are non-recognition events. So yeah, we did transfer assets of more than $1 million. We transferred cash, and so we disclose that there, and then we'll attach the statement. The rest of these items, all no, at least for this company, they might apply to you. If so, answer yes, and then attach the appropriate schedule or form as required. Now, the corporate AMT was something that was kind of repealed, and now it's kind of reared its head again for very large companies, right? So large companies that need to pay minimum tax based on their book income. So we're really looking at companies with in excess of 500 million gross receipts, but in this case we are very, very small, so none of the corporate AMT applies to us, and we meet that de minimis safe harbor because our revenues are just so low, right? So it's not a problem for us. Okay, so Schedule L, balance sheet per books, right? So this is the balance sheet per our internal records. So we have the cash, the building, and other fixed assets, and then the land is separately stated on line 12. So our total assets, $1.239 million. And again, notice that we aren't recording any depreciation for book purposes, so we don't see any accumulated depreciation reported on line 10B, but we are going to be claiming it for tax purposes. But because we're asked to input this Schedule L as the balance sheet per book items, we're not going to see it. So line 21, other liabilities, we have the tenant security deposit, $1,000 of capital stock, $1.2 million of APIC, And then the retained earnings per books, we have $24,662. The total liabilities and equity is the $1.239 million. Okay, so the M1 and M2 reconciliation. So M1, we do have our net income or loss per books figure. And then we do have these various adjustments here to get to our taxable income or loss. We'll come back to this a little later. I want to start with page 1 of the 1120. And so we'll look at this and then look at that 8810 worksheet. So normally when you prepare the corporate tax return, if you don't have these passive activity loss calculations, you can just use the taxable income calculations per the 1120. So you would report the gross amounts of all these expenses. You would report the total amounts of depreciation expense for tax purposes, and you would have this net loss figure. Because we have a passive activity loss issue, we cannot record the total amount of the expenses. We record the gross amount of the rental income, but we have to reduce each of these expense items by the unallowed portion. So you'll notice here at the end of it, what is going to happen, we have the total amount of rents, but we're reporting a smaller amount of each expense, and then the net taxable income, when everything is said and done, is just going to be zeroed out. So the total deductions will match the total revenue for the corporation. So how does that 8810 worksheet? Well, because this is a first year, the computation is a little more straightforward because we don't have to carry over any unallowed deductions from the prior period. But we take the taxable income or taxable expenses that would be allowed for federal tax purposes, the ratio of the expense to the total, right? So we're looking at the ratio of this expense to the total of the expenses for each one. And then the unallowed deduction is going to be the ratio times the net loss. So unallowed deductions are going to be the excess of the expenses over the revenue, right? And so that is first calculated on the 8810. So if we go to the tax return, let's jump down to the 8810. So this is the corporate passive activity loss and credit limit schedule. So in part 1, we have the total current year income. We have the current year deductions, $137,245. So the excess here, the net loss, which is going to be the unallowed deductions, is $95,245. And so ultimately, the total deductions and losses that are going to be allowed is just $42,000. So the total revenue is $42,000. The total amount of deductions that we're going to be able to claim also $42,000. So if we look back at this, what we can see here is, again, we've got the total deductions, $137,245. We have the unallowed portion, $95,245. So this balance represents the amount of deductions that we can claim on the tax return. So we can claim $305 of cleaning fees. We can claim $79 of advertising, and so on and so forth. All right. Now, depreciation expense, again, the reason why I've separated all these out is because when we do the 4562, we have to reduce each line item and report the reduced or allowed portion on the 4562. Right? So normally when you look at your reconciliation, you might just clump all these together and then they're separately stated on the 4562, but we can't do that in this case because we have to be precise in how much is going to be allowed based on each item and the class life. So let's have a look at the 4562 and the depreciation schedule. So the depreciation schedule, right, we have 4 items listed, right? So we have the house itself, the residential rental property depreciated over 27.5 years, land $250,000, that's not going to be depreciable. So you can see here depreciable basis is 0, no current depreciation. We've got the improvements, and then appliances, carpets, furniture, fixtures, all those other items that are going to be the 5-year property. So we've got the costs associated with each item, the bonus depreciation column. So we can claim bonus depreciation on these 2 items, right? The land improvements, the appliances, and note that it's 80%, right? So $45,000 is the cost attributed to this line item. The current year bonus depreciation is going to be 80% of that, so $36,000, which reduces the depreciable basis to 9. So the bonus depreciation that can be claimed this year, those two amounts results in $104,320. And then we can claim the straight line depreciation for the remaining amount. So depreciable base of the property, current depreciation is going to be $13,579, $300, $1,708. So we've got a combination of straight line depreciation for the year, $15,587. Current year bonus is going to be $104,320 for a total available depreciation of $119,907. Now, if you didn't have these passive activity loss limits, you would just claim the whole thing. If you had enough income, obviously, you would claim the whole thing. But because we have the PAL limitations in place, we cannot claim all of that. We have to reduce those line items by the amount that's unallowed. And so that's what's being done on this worksheet. So we've got the depreciation amounts, the bonus, and then we are reducing them by the unallowed portion and then claiming the allowed portion. So we take the allowed portions for each item and then report those on the appropriate line item on the 4562. So the bonus depreciation amount, right, has been reduced to $31,935. So that's the total bonus depreciation we can claim. And then in section B here, the amount of depreciation deduction on these remaining items is reduced to the 527, the 90, and the 4159. So the total depreciation that we can claim for the period is going to be $36,711. And so if we total all these up here, we've got the $36,711. And again, that's the total depreciation that is deductible after factoring in the Form 8810 unallowed piece. Okay, and then if we take the remaining amounts here, go back to page 1 of the 1120. So we've got the allowed portion of repairs and maintenance, the allowed portions of taxes. There's our depreciation coming through from the 4562. Allowed portion of advertising, and then the statement 5, we have the allowed portions of those other expenses. So the allowed portions of the accounting costs, the insurance, and so on and so forth. All right. So once everything is entered, again, it zeroes it out, right? So we have a passive activity loss, right? Can't deduct that. So the excess expenses are labeled as unallowed and carried forward to those future tax years. Okay, so now the question is, how do we pull all this together in the M1 reconciliation item? So if we have a look, let's jump down to Schedule M1. So Schedule M1, the reconciliation per books with what's on the return. So remember, the return is showing 0. So we have 0 taxable income for the year because of the PAL limitations. But our net income or loss per books is $24,662. So we need these reconciliation items. So what do we enter here? If we look at this worksheet, we've summarized the amounts here. So our net income or loss per books is the $24,662. We have deductions that are on the books that are being unallowed via the Form 8810, so the PAL limitation. So this amount, the $12,049, is the unallowed deductions, and these are the deductions that are not the depreciation. Okay, so I've separately stated those. So we have an add back for deductions unallowed. We have depreciation on the tax return that wasn't recorded on the company books, right? Remember that the company does not record depreciation expense internally. So the $119,906, so that's those 5 items here. So $119,907 is the depreciation, but then we have the add back for the piece that's unallowed. So the $83,196 is the unallowed depreciation expense, and so that's the totals from this column here in the unallowed deductions. So once everything is added up, right, add all these together, it zeroes out to nothing, right? So again, that reconciles with what we have on our tax return. So we've got statement 16, the unallowed piece of deductions, $12,049, and the net amount of depreciation. So if I jump to the supporting statement here, so statement 16, expenses on the books that were unallowed because of the PAL limitations. I've separately labeled each one just so the return is complete, right? So whoever's reading this can clearly see what expense was unallowed and for what reason. So we've got the Form 8810 unallowed for each item, and then the same goes for the depreciation. So the total amount of depreciation that was available is the $119,907, and then the unallowed depreciation of $83,196. So the net amount that's actually being deducted is the $36,711. Okay, so that covers all of those numbers. Let's now have a look at the 5472. So remember, our structure chart here, we've got a U.S. corporation with a foreign owner, both directly and indirectly. And so generally you need to be filing the 5472 to disclose that foreign ownership and enter any kind of other reportable transactions. So the 5472 here, the reporting corp is the U.S. company, so the Fake Holding Company, Inc., that's the Wyoming entity. We have the principal business activity, real estate rental, the activity code. Now the total value of payments made or received that are being reported on this 5472 is the $1,000 intercompany payment, the shared accounting costs. Right, so if we have a look at part 4, I'll come back to the page 1 here. This is where we disclose any monetary transactions that happen between the reporting corp and the foreign-related party. The foreign-related party in this case is that Cayman Islands company. So if you have any revenues or expenses that are going back and forth between the U.S. corporation and the foreign owner, those should be disclosed here. So we have on line 29 that the U.S. company paid $1,000 to that foreign corporation for like services, right? You can put anything that was paid for technical, managerial, engineering, construction, scientific, or like services can be reported on this line item. All right. So that's why we have the $1,000 being reported up here on lines 1F and 1H. Now, 1J, this is the initial year for which the U.S. reporting corp is filing a 5472. We're only doing one. 1L, so the company is set up in the U.S. and the operations are conducted in the U.S. and we file a U.S. income tax return as a U.S. resident. Date of incorporation for the U.S. company, that should just match what's on page 1 of the 1120. So we have Jan 15. And then item 2, check here if at any time a foreign person owned directly or indirectly at least 50% the voting or value of all classes of the stock. In our case, yes, right? So we have 100% owner. So we've checked that box there. Now, part 2, the foreign shareholder and direct and indirect information. So the direct foreign shareholder is reported on 4A. So we have the Cayman entity, not real holding company limited. The mailing address for them in Cayman. The company does not have a U.S. tax ID number, so foreign U.S. is an OK placeholder. And then lines 4C through 4E are all Cayman. Okay. 6A is when it starts to ask for ultimate indirect owners, right? So the ultimate indirect owner, so they're asking for the UBO, right? Who's the ultimate beneficial owner here is Hans, right? So Hans Smith, this is his mailing address in Dubai. He also does not have a U.S. TIN, so foreign U.S. is the placeholder. And if he has a foreign tax ID number, you can enter it as such. Principal country where business is conducted and where he's a resident is Dubai, or the UAE, that is. And then his citizenship is Germany. And then again, part 3 applies to part 4. So the related party in this context is a foreign person. It's the foreign owner, the Cayman entity itself. And then in line 8, we indicate the relationship is that it is the 25% or greater foreign shareholder. And then again, as we highlighted already, in part 4, we would report any kind of monetary transactions between the reporting corp and the foreign related party listed up here. And so that's where we disclose the $1,000 payment for the shared accounting services. Now, parts 7, 8, and 9, In our case, none of these apply. So, for example, right, we're not importing goods from a foreign related party. We're not participating in any kind of cost-sharing arrangements, so all of these questions are just going to be no given our circumstances. We don't have any intercompany loans for which we even need to worry about the safe haven or safe harbor rules. So go through each of these, see if they apply to your circumstances or not. In our case, they don't. So Part 8, cost-sharing arrangements, not applicable. Part 9, we don't have to do anything with the BEAT, base erosion issues. Okay. Federal supporting statements, so we've already covered that. Those are supplemental statements to what we had listed above. Last item is the 351 statements and the de minimis safe harbor election. So anytime you transfer property to a corporation in exchange for stock, you want to be certain that that's done in a non-taxable fashion. And so Section 351, that is the case here, right? And so they do ask that the transferor is generally the person that has to attach the statement, but in this case, the transferor is a foreign corporation that doesn't have a filing obligation. So if that's the case, then the transferee corporation, the entity that received the property and then gave up the stock, they can include it on their return. So that's what we've done here. So we have a 351 statement by the company, Fake Holding Company, Inc., the transferee corp, and we've listed out the information on the transferor. So Not Real Holding Company Limited in Cayman. The date of the transfer was on January 15th. The property contributed was cash, and the fair market value of that was $1.2 million and $1,000. De minimis safe harbor election, so the tangible property regs that were passed many years ago, you can expense certain expenditures that would arguably otherwise have to be capitalized so long as they're small expenditures, and so we've included that election statement. All right, so that covers it for this tutorial. I think I've got everything in there. I haven't missed anything, but if you have any questions, obviously feel free to leave a comment below. I try to get to as many of those as I can. And as always, I look forward to seeing you again on the next video. Thank you.